Welcome to the February 2026 Market Update webinar. My name's Wayne Terry. I'm from Financial Edge Group. We specialise in retirement planning. Today we have Jesse Field and also Martin McGrath, my colleagues who are financial advisors here. And we also have the pleasure of Daniel Moradi being with us. He's the Australian Equities Portfolio Manager at Lonsec. Welcome, Dan.
Thank you. Good morning.
So I guess we'll jump straight into it. Given you're the Australian Equities Portfolio Manager, we'll start there. From an Australian equities perspective, how would you describe the environment we're currently investing in at the moment?
It's certainly been a challenging environment for our market. We've just been through a 3-year period of flat profit growth for the overall market as a whole. And this has been driven by the two largest sectors in our market, which are the banks and resources, which account for more than half of the market cap on the ASX. And what we've seen over the last 3 years is steady earnings growth from the major banks, which is being offset by a persistent earnings downgrade cycle in the resources sector, which has been driven by lower commodity prices. So the net impact has been more or less a flat outcome from a growth perspective for the market. At the same time, we went through a very sharp rate hiking cycle from the RBA, which added additional pressure on consumers, which also hasn't had a positive impact on demand. But we have seen a reversal of this trend quite sharply since October last year, where we've seen material earnings upgrades in the resources sector, which has lifted the EPS growth profile of the overall market from about 4% growth to 13% growth, which is pretty impressive. But this has been primarily driven by commodity prices, and particularly focused on base metals, precious metals like gold, copper, lithium. The bulks like iron ore haven't participated in that rally to the same extent. So it has been very concentrated. And not surprisingly, the returns from the resources sector have been driving the market higher of late as well because of that. In fact, looking at the returns over the last 6 months, resources have gained over 40% in that period, whilst the rest of the market is at minus 1%. So it hasn't really been driven by fundamentals across the market. EPS revisions aside from resources have been lagging, and most of the sectors have been getting earnings downgrades over the same time frame, where resources have been getting upgrades. So what we actually really need to see is a broadening of growth expectations in the industrials universe to gain a bit more confidence in the sustainability of this earnings recovery at the moment on the ASX.
So Dan, just obviously lots of clients going to be listening with different kind of backgrounds, etc. But yeah, a few key things you said there. EPS stands for earnings per share, and effectively what you're saying is that shares will only go up if their earnings or their profits go up. So we need earnings to go up to make the shares go up, etc. Shares don't just go up willy-nilly. Sometimes they do for other reasons or factors, but generally shares will go up if companies are making more profits, etc. So you touched there on interest rates. I suppose I might say on that kind of line of thinking. So, yeah, I mean, definitely in the last 12 months, we've had a few cuts, and now we've had a rate rise. Thoughts, intention, or crystal ball about where interest rates might be going or not in Australia around the globe, and again, how that might affect things for particularly retirees.
Yeah, look, it's very topical. Obviously, the RBA had to come and increase interest rates because they were uncomfortable where inflation was heading. And obviously, given the indebtedness of Australian households, higher interest rates do tend to have a negative impact on discretionary spending, increasing the cost of capital for companies. So whilst the 25 basis point rate increase, which is what we got from the RBA last week, is not a game changer, it is an area to monitor. There are certain sectors on the market, like consumer discretionary and interest rate sensitive businesses like your real estate, utilities, and small caps, which have a higher sensitivity to movements in interest rates, might lag the other parts of the market. But at this stage, we don't expect rates to move materially higher from current levels. The market is expecting maybe one more rate hike in May or June this year. That's if the CPI or the inflation prints remain elevated for next quarter. But our own inflation indicators do suggest that the pressure should start to fade away over the second half of the year. But this is really data driven, and this is an area we're keeping a close eye on. At this stage, we're not making any major adjustments to our growth expectations just because of the RBA rate hike this month.
Just staying on the interest rate changes, Dan, with an environment with higher rates, how they do tend to affect companies differently, increasing their cost of capital. Which type of sort of Australian businesses cope better in this environment, and which do really struggle?
In terms of businesses that perform well in a rising rate environment, you've got your banks, which is higher interest rates is typically good for their margins. You've got businesses like insurance companies tend to do better because of the big float that they have, and they earn interest on those funds. Typically, energy and resources and commodity businesses do well if those rate rises are driven by inflation, which is an indicator of increasing demand. And generally, companies that have strong pricing power. We saw this over 2022 and 23, where companies that were faced with higher input costs because of inflation increasing were able to pass those costs through without impacting the overall business. They fared much better than businesses that do not have pricing power and cannot pass those cost increases through. And on the flip side, you have businesses first and foremost that have too much debt. And that means higher interest costs, and that gets the business in a bit of trouble. So those businesses tend not to do well. More leveraged small companies that don't have the scale of the larger companies tend to lag in such markets. Businesses that are exposed to discretionary consumer spending, because naturally as interest rates go up, mortgage repayments increase, and consumers tend not to spend so much on discretionary needs. So that those types of businesses don't perform well as well. And lastly, just businesses that are sort of hard assets like property trusts and sort of utility and infrastructure businesses that their valuations is linked to interest rates tend to lag during those periods as well. And that's the level sort of we go through in terms of looking at our portfolios and on a look-through basis, looking at how much exposure we have in each sector to make sure there's not an overall bias to companies that are going to not to be doing well in a higher interest rate environment.
Yeah, that's a really good rundown of how interest rates affect different stocks. People might have seen me smirking a bit there because I happen to hold a stock that owns every single Westfield in Australia. So I've noticed that they come off a little bit recently purely because of the expectation of a rate rise. And then since then, they've obviously come off a little bit. But in addition to that, that particular company, is linked to consumer spending as well because of the way they earn their money through rentals of shops in the Westfield. So, yeah, really good rundown. I guess changing pace a little bit now, Dan, looking more, I guess, globally. So, there's a lot of uncertainty out there in the markets around, I guess, economic uncertainty with, different countries having different interest rate agendas, particularly America. There was talk about installing a particular person into a position with the Reserve Bank there to maybe have a bias on the downside, and whether or not that's true or not remains to be seen. But then also, I guess geopolitically, there's lots of things happening in the world, whether it's wars, Russia, Ukraine, Israel, Gaza. You've also, had a lot of rumblings in recent times around, China, Taiwan, that kind of stuff. And then even big investors out there like Ray Dalio talking about, China potentially becoming the new empire, so to speak, rather than the US. Happy to hear your thoughts around all of those things and how they affect more, globally.
Look, that's fascinating. All those factors are constantly, topical in the news and discussed. Look, in short, all these matter a lot to Australia, given Australia is a small, open, commodity heavy economy, and that makes us highly exposed to the global forces and what's going on around the world, even if the domestic conditions seem stable. What we do need is to separate the cyclical noise and the shorter term issues from factors that are going to lead to structural shift, and then assess Australia's specific exposure to that shift. Cyclical risks means things like we mentioned, geopolitical issues, monetary policy in the US, financial market volatility. These factors tend to have a short-term impact on our economy and our market. So that, or you can put that in the sort of the short-term noise bucket, whereas the longer-term structural issues can have a far greater impact on our economy. And some of these include things like deglobalization, and all the trade issues that we've been witnessing over the last couple of years, the China's structural slowdown, the energy transition that we're going through, and sort of structurally higher inflation and interest rates. These are the factors that have a long-lasting impact on our economy and our markets. For example, deglobalization and trade wars could lead to supply chains becoming less efficient, which leads to higher costs, and that which will feed into higher structural inflation, which is going to impact us, given that potentially that's going to lead to higher prices, and then we get caught in between issues that are happening between the US and China as well. On the China front, for example, China is perhaps the single biggest risk factor for us, given that China is our largest customer. And they've been going through their own transition. This is something that needs to be managed from an investment perspective, particularly as China is transitioning away from an investment and export-led manufacturing model, which the last 2 or 3 decades, they've been going through that phase, becoming the factory of the world per se. And now they're transitioning to a more internal consumption-driven economy to combat the issues that they're going through in their property space. There's overcapacity now after years of additional investment. There's debt issues, and they've got an aging population as well. So all these factors will end up having a structural long-term impact on our economy in the long term. It's very difficult to forecast the outcomes. We know that these structural shifts take time to play out, and they will result in bouts of volatility. They're likely to reshape Australia's growth model in the future, which could potentially change the earnings composition for our market. We know the iron ore is a large part of our market, and if China's demand for iron ore reduces, that's going to have an impact on the profitability of our market as a whole. Our fiscal policy, what the RBA does, our housing market dynamics, and investment flows into the country. So there are a lot of factors at play. So it's important just to remove the noise from the short-term factors, focus on the long-term, and make this sustainable investment decisions based on how those longer-term themes play out.
Yeah, that's great.
Dan, there's been a bit of a gold rush lately with people physically lining up for hours to buy physical gold. Now, gold has historically been flagged as a bit of a safe haven, essentially, and with Wayne mentioning that key theme around uncertainty and inflation and everything like that in the media at the moment, the headlines, what is really driving this investor behaviour? Is it purely that uncertainty that's around in the market at the moment? And how do you evaluate these sort of prices, or where gold is at the moment?
Yeah, like, look, very topical. I've seen those lines outside Martin Place in Sydney with people lining up. I don't quite know why they would be lining up, but there's other ways of getting exposure to it. But look, just as I guess as a backstory, uh, since the start of 2020, gold price has risen by around, I think, 170%. And if that's not strong enough, it's pretty much doubled since Feb 2024, compared to a 20% gain in the preceding 5 years. And now you understand, because of these movements, why gold is, it's a topic of every CIO call and media headlines and barbecue conversations, because of the returns that are being seen by everyone. And this is not a normal behavior for a defensive asset, as you say, in terms of a safe haven asset. Gold has outpaced most major asset classes. And the drivers behind it aren't just the usual suspects like inflation going up. Gold provides a hedge for inflation or interest rate expectations. These short-term factors matter, but I think there's something deeper that's been happening beneath the surface in the gold market. You've got the persistent geopolitical uncertainty, and you've got a once in a generation now shift in central banks around the world, which have typically invested their reserves in US dollars, wanting to diversify away from US dollars because of the concerns that the US dollar is going to be devalued in the future because of the amount of debt that country has. So what they're doing is they're diversifying their holdings and adding gold to their reserves, as an insurance policy, if you like. And that's been the real big buyer in that gold market, if you like, from a structural perspective, because it's not just one or two central banks around the world buying gold. It's pretty much all of them that are doing that because they've had that such big exposure to US dollars, and that's probably not sort of the wisest thing to do now, given the way the US is looking from a fiscal perspective, and from how much debt they have and their interest bill. So look, and from our perspective, we've got to sort of ask, does gold still matter in our portfolios? We've had gold in our portfolios since 2020, and look, it's up and down over the very long run. Returns for gold have been very modest. So if you go back 100 years, gold averages about a 5% return per annum. So it's not great, not spectacular, nothing like we've seen. But where it gets interesting is that gold's value isn't really about the average return. It's what it does during the worst moments in the market. That's where the gold's contribution to the portfolio really shines, in terms of gold performing well when recessions hit, gold performing well when there's geopolitical risks, or inflation, or people's confidence in central bankers decline. So that's where gold helps. Gold is volatile, and basically what you're trading off by having gold as a part of your assets is you're going to be getting slightly lower returns in very strong bull markets, and gold is going to lag other growth assets like equities, but you'll have a shallower drawdown when things go bad. So it's a good sort of insurance hedge to have in the portfolio during times of uncertainty. And as you said, this could be one of those times where in investors' minds that uncertainty needs to be dealt with.
Yeah, fair. I think Lonsec have had in there for a while, which we like and support, and it's helped our clients. I suppose the Lonsec conservative approach to protect that downside for us is key. But yeah, it's hard. Like if a share price doubles over, a share price earnings double over 10 years, well, the share price should also double over 10 years. But gold doesn't produce a yield or rental return or something like that. So valuations can be hard. There's obviously been a lot of various articles that it's going to hit this figure or that figure or those kind of things. So, I mean, not putting on the spot too much, but it's been the portfolio with the continued uncertainty. I'm assuming it's probably staying in the portfolio for a little while, but maybe not on the expectation it's going to double again next year or two, but just purely as that protection hedge, Dan?
Yeah, look, you're absolutely right. It's impossible to value it. It doesn't have an income stream. It's just a commodity, but which has been regarded as a solid store of wealth for many years. So the conversation is now that it's done so well, what do you do with it? So then this is where you go back in terms of why do I have it in my portfolio? And it's basically one of the key characteristics of gold is that it is not correlated to the other assets that you hold in your portfolio. By way of what that means is that it doesn't behave in the same manner as everything else that you hold. So that really adds a really good diversification angle to your portfolio, because you know when that part of the portfolio does something, gold is likely to be doing something different. And the two central facts that we want to have protection against is that potential further devaluation of the US dollar, which is gold is priced in US dollars, and it's going to have implications for a lot of assets, and it's going to be positive for gold if the US dollar keeps declining, and the valuation front in terms of if you are selling your gold, what are you going to be buying instead of it? So if there is a left field shock event coming through the market, causes some sort of a sell-off in the market, and there's some really attractive growth assets that you can purchase at a much more attractive valuation at a cheaper price, then you could potentially use gold as a funding source, knowing that a lot of those risks that you wanted protection for by holding gold has already been priced into the valuations of some of the other assets. You can use that to rotate some funds away from gold and into those equity holdings. Or if there is a really good fiscal discipline in the US and they start coming up with a tangible plan of reducing their debt and paying their interest bill and reducing that interest bill, then you go to the conclusion that I don't need as much gold in my portfolio because that risk has been reduced significantly. But that hasn't happened yet.
Pivoting from gold that's been around for a long time to something that's more new in AI. So it's hard to miss news and emergence of AI, and AI is going to take over the world, those kind of things. How do you see that, I suppose, role in the markets? AI is going to be investors instead of other things, or Australian companies investing into it, that kind of thing. What's your thoughts or take on AI and how that's going to play out?
Yeah, look, it's a fascinating topic, and it's creeping up on us faster than we all thought. It's absolutely front and center for global markets right now, and it's been one of the factors that's been actually driving markets higher over the last 2 years. So those positive returns particularly from global equities that we've seen has been driven by AI. AI is already affecting sentiment and selective earnings expectations in Australia, but it's not really broad-based yet, and it's not a key driver of earnings on our market. That's because, unlike the US, we don't have those mega technology companies of cloud providers and semiconductor manufacturers and AI model developers and hyperscale data centers. So that's more of a US exposure. So structurally, Australia is not an AI infrastructure market, but there are indirect and selective impacts on our market, and not just our market, every market in the world. So we're seeing right now the technology and software companies are in the firing line, with recent. I'm referring to the last 2 or 3 weeks. With releases and info coming out from these AI models, and now the market is questioning how much of a threat AI will be to the business models for most of the software companies, not just in Australia, but just around the world. And no one really knows the outcome because of the pace of the advancement that AI has been achieving. But look, it doesn't end there. It's likely to impact most sectors on the ASX at some point. AI should be considered both as an opportunity and a threat. And one could see a major shift in how businesses and consumers operate in the future, because this theme is not going away. People shouldn't be scared of AI per se. It's businesses can invest in AI and utilize AI to increase efficiencies, improve margins, improve profitability. And as you said earlier, it's profitability that drives the returns and the share prices. So unless your business model is at risk of total replacement by AI, it should be really a net positive for companies over the next decade.
You kind of stole my thunder a little bit in one of the questions I was having when you're talking then about whether it's an opportunity or a threat. So I think you've covered off on that. My other question is, and I know you're the manager for the Australian equities, but Lonsec has portfolios that have international exposure. So I'll ask the question anyway. There's been a lot of talk around AI and the investment in it. In other words, the capital expenditure that companies are making. I think Google, I noticed in passing the other day, they've got a budget of like hundreds of billions of dollars a year throwing towards that. So there's definitely going to be some winners and losers out there. Yeah, can I get your thoughts around that and how Lonsec manages that side of the portfolio, being the international exposure?
Yeah, absolutely. Look, it's as I said, the domestically we don't have a huge amount of companies that are at the forefront of that space, whereas in the US market, for example, which is a large part of the global equity space, I think the US market roughly accounts for about 70%.
70, yeah.
That's right. So it is. So the good news is that we've had a meaningful allocation to that part of the market. That's the beauty of a multi-asset diversified portfolio. And we've gained this exposure through our global equities allocation, where our largest exposures to global equities have been to the leaders in this space. So including companies like NVIDIA with their chips, Google, Microsoft, Meta, Amazon, all these companies are at the forefront of AI, and they're investing literally hundreds of billions of dollars every year. This is each of them, not combined.
Trillions.
That's right, into this space. Now, if they weren't this size and scale, there's no way that they could do it. And the beauty is that they're not overly borrowing money to do this. They're self-funding it because they're such great profitable businesses. So they have recognized this. What this tells us is they've recognized the opportunity set here, and it's an arms race to get there and get there first, or be one amongst the first to get there, to set up this infrastructure and then to profit from it. So they're investing in it now, and then profits are expected to come later. So the good thing is we've all in our portfolios have had perhaps our largest exposure within global equities to that space. And they remain major holdings in our global equities. There's concerns about overinvestment, about the risks, about returns on capital that's being put in, and all the borrowing, and all valid points. I think, as with anything, if history is a guide, you'll have, if there's something good, everyone wants to invest in it. It'll end up being over-invested in, and then there'll be some casualties in that space in terms of ones that they're not going to be able to generate a return on the money that they've put in. But once again, from our global equities perspective, we tend to stay away from unprofitable exposures in that space. So we want the leaders, the largest players in that space, which those magnificent 7 businesses are. And at the same time, you've got to think about the risk in terms of, we've had very strong period. How do we manage that risk in our portfolios, in our global equities? And as I mentioned, they are a very large part of the US market, and that subset is even a larger part of the US market on the look-through basis. So we do that by managing the actual exposure we have to those, by making sure that it's more balanced. Then you don't want 40% of your US portfolio to be just invested in 7 stocks. Yes, they've been doing well, and if you had, you would have done really well, but this is not what it's about. It's about managing risk. We know they're good companies, but we don't want to once again put your eggs in one basket. So we're managing the exposure to these companies through the overall weighting that we have to them, and that can get managed up and down depending on the progress that they're making in towards profitability in this space.
Valuations, Dan, they're often talked about after markets have already moved, and you talked about positioning portfolios to the bigger, stronger companies overseas and even domestically as well. How important are valuations in your portfolio decision making today? And are you finding any pockets of value at the moment with indexes around the world pretty much breaking all-time record highs or flirting around those record highs for so long?
Yeah, look, valuation is a key pillar in our asset allocation framework. So it's something that is monitored, it's discussed and reviewed constantly. But it's also important to note that earnings do matter more than valuations. And valuations are not a great short timing tool for the market, but they are critical for managing long-term risk and returns. And we know that markets can stay expensive or cheap for years or a very long time and be detached from the underlying fundamentals for a long period of time. But when you're looking at that longer term 5 or 10 year time frame, the starting valuation is key. It's very important. It's a good predictor of your future equity returns, your drawdown, your volatility. And that's because basically, if you think about it, your return from these investments is derived from three things: the earnings growth of the company, the dividends that you receive from the company, and the multiple that the company is valued, which is what goes up and down, which is what we call valuation. So if you pay too much, then your future multiple has to get lower based on fundamentals, and that will drag your returns down. And if you can get in on an attractive valuation, and what your portfolio is, how your portfolio is valued, does dedicate how the returns shape in the future. So this is why we monitor the valuations for every asset class to help us in our decision-making process. And in terms of the sectors that we're looking at, broadly speaking, on a global scale, the valuations are elevated. They're very close to the 20-year peaks, but that's been the case for the last few years. So it's not a new thing. And as long as the earnings grow, then the valuations can be justified. At the moment, where we are seeing pockets of value are in emerging markets because of the recovery that we're seeing in that part of the world. We're seeing relative value in global listed infrastructure and global listed real estate. There's two sectors that are actually not under threat by any way from AI in terms of their business model and their hard assets, and they've got some very steady, reliable growth within those businesses in those sectors. So those two sectors are sort of screening as relative value compared to the rest of the world. And I guess in the sort of the bond side of it, in the defensive side of the portfolio, the longer term government bond yields, potentially, particularly in Australia, where you can get a yield of between 4.8 and 5% for that highest credit quality investment, is screening as relatively attractive compared to what it had been in the past. So that's sort of four areas of the market that we see as attractive, and that's four areas of the market that we do have a slightly larger allocation to in our portfolios.
Yeah, I think that's key, and picking up on that, I think investing is about the long term. It is about diversification. The way that most of the portfolios we look after, particularly ones we use Lonsec for, is that we're going to have exposure to all the sectors, but there's times where we're going to tilt. Some of these macro environment things are going to be important there to tilt either way. It's not an all or nothing. It's okay, are we overweight, underweight, that kind of stuff as well. So I suppose continuing that theme a little bit, I suppose consolidation or the big companies getting bigger, those kind of things, either in Australia or overseas. Different change in Australia, but Combank, BHP, those kind of guys are taking up a fair size of the index, and overseas, I suppose some of those tech companies around the globe are inching up, and the bigger are getting bigger. How do you see that playing out, I suppose, in two parts? One, in 50 years, will it just be four companies and they're going to own everything? And then in the meantime, how do we find that concentration risk of, okay, that stock was, NVIDIA was only this much a portfolio, now it's that much. How do we find the right level of diversification as these companies grow and become bigger?
Yeah, it's become a bigger issue of late, but look, it's something that's always been, because you've got your sort of super companies growing, outperforming everyone, and they go through these phases. and they become very large. We had energy companies in the past, or resources, or banks domestically, but that's a fact of life. It is what it is. They're on top of the list, and they've got larger allocations in certain markets because they've been such successful businesses. So there's a reason there why they've got such a large allocation, large size, because they've been really successful and very profitable. But from our perspective, we are trying to achieve an objective by managing our portfolios, and diversification is key. You don't want to put all your eggs in one basket, and this is more about just the number of investments that you hold. The key to long-term success is identifying 15, 20 investments that are not correlated. That maximizes your returns and manages the risk. And that's why we spread investments across asset classes, stocks, bonds, commodities, geographies to gain that. And there's a drawback of that strategy when, particularly domestically, we're just going through it right now. We've got the two sectors in the market forming more than 50% of the allocation in the Australian equities market. So you've got your big four banks, which are all correlated together. So it's essentially one big exposure to banking. And then you've got the big three miners, which is Fortescue, BHP, and Rio, which gives you a massive exposure to those bulk commodities and iron ore. So essentially half your portfolio is exposed to two themes, iron ore and banking. Now they might do really well, and by having that exposure, you'll do really well, but the risks are significantly high, because if that doesn't pan out, that is going to end in a very difficult, different outcome. So that's why the exposure to those underlying sectors is really monitored by us to make sure that there is no over-reliance or too much of an overweight to one particular sector that can have an adverse outcome for returns if things don't go well. Last 12 months, we have seen the resources sector return 44%, which is phenomenal. So that's a part of the market that's returned 44%. Everything else, which is the other 75% of the market, is down 1%. So you can see the divergence and the disparity. So if you were too skewed to resources, you would have really fantastic returns. But if you were diversified into the X resources space, your returns would have been muted. So, and most people should have probably been sort of more balanced between the two. So you're not going to see those returns at the market level because the 44% return from that one particular sector has skewed returns. But at the same time, the risks for that particular portfolio would have been very high. So from a risk management perspective, we need to diversify, and it's the same case in US equities. Those 7 businesses form over 30% of all the market cap in the United States. So that is on an absolute sense a very high allocation to have just to 7 businesses, which are pretty much driven by a very similar theme of technology and potentially AI now. So the way we manage that is to reduce the weighting that we have in the portfolios to those specific themes, just from a risk management perspective. Doesn't mean we don't like it, doesn't mean they're not good companies, but you've always got to keep in mind we need to be diversified. We can't have too much exposure to that one particular theme or asset class or underlying asset, because if things don't go well, that's going to really cause a deep drawdown that we're trying to avoid.
This has been really good, Dan. We're coming up to probably, I guess, a bit over half an hour now. So I'll ask a closing question, and it's a bit of a two-pronged question. As you've been talking there, I've been looking at what the market's doing now. So just for, not that I want to timestamp too much, but we're recording this on a Friday. Last Friday, we had something like a 2% decline in the markets. And then the first couple of days this week, it was, up and made that back and maybe then some. And then today, I'm looking at it right now, it's down 1.2%. Although I know that my portfolio is up 2%, so I'm 3% ahead. But a lot of the time in this sort of volatility, you'll hear about the volatility in the nightly news. The guy will get up on the screen saying in finance today, the ASX dropped 2%, but you won't hear about the, 1 or 2% that makes back the next week. You only hear about the bad things. So I guess for the average person watching this who isn't as well versed in the financial markets as you or I or Marvin or Jesse, what would be your message to them about how much attention to pay those headlines? And the two-pronged question is, for Lonsec, how are you looking to, I guess, manage things over the next, say, 12 months or so? What's the things that are grabbing your attention?
Yeah, look, it's very topical, interesting question. The first advice would be not to look at the market every day if it bothers you. But look, generally speaking, what volatility is a part of life. It's nothing new. We go through phases in the market where there's high volatility and low volatility. And on what we're experiencing right now, looking back at history, there are always risks. There's new technologies, geopolitical issues somewhere in the world, structural changes happening in any particular sector at any given time. So from our perspective, from my perspective, volatility means opportunity. Because if you're looking to invest in quality assets that everyone else wants to invest in, volatility creates an opportunity for you to purchase an asset at a more attractive price than otherwise. But from our perspective, look, a well-managed portfolio is not built reactively to market conditions in terms of the volatility and the news flow. Before the volatile periods, we're already thinking about diversification across geographies, across companies. This is exactly what we were talking about before, about not sort of being too overexposed to one particular thematic or region or company. You got to look at your concentration risk in the portfolio, your liquidity risk in the portfolio, balance sheet exposures, correlation between assets. So all these and many other factors are already factored in to our asset allocation model to come up with the end result that captures and balances all these risks so that we don't have to react to every shock that's out there. The goal is not to predict every shock. The goal is to build resilience in the portfolio in advance so you don't have to. And when volatility hits, we look for opportunities to adjust the portfolio at the margin, not rebuilding the portfolio or going to cash because there is a sell-off in the market. So our aim is first and foremost the long-term returns over that respective over the respective time frame for the risk profile that we've built the portfolio for. And look, the important thing is that the bulk of your returns from a multi-asset portfolio is generated from its strategic asset allocation, and that needs time to play out. And look, we've built a track record of over 20 years with every single portfolio, with every single risk profile that we've managed over that time frame has exceeded its return objectives for that period. That's despite the GFC, that's despite COVID, that's despite everything that's in between. And there's been a lot of volatility in that time frame. But if you stick to your investment beliefs and your long-term investment horizons, that's the best way to, I guess, be at peace with the volatility that you're seeing in the market and know that we are looking at that volatility and we are looking for that opportunity that we've been waiting for, that the market's presenting itself to us.
Very good. Yeah. Yeah, and I think that sort of ties in with, I guess, the Financial Edge Group's investment philosophy for retirees, the way we structure portfolios, I guess, solves some of those volatility issues. That's the point. You need to structure things correctly to begin with because we don't know when the declines are coming or when the opportunities are coming. All right. Thanks very much, Dan, for joining us today. It's been a really good conversation, and I hope that everyone out there watching has got a lot from it. We certainly have. And yeah, if you have any questions, please type in some comments or send us some messages. We'll be happy to answer or assist you in your retirement planning.